Welcome to my lecture series on group accounts. In this lecture, I will examine the intragroup trading, intragroup current accounts, and the treatment of impairment loss in group accounts. If you are coming across my lecture for the first time, please like the video, share it with others, and subscribe to the channel so that you won't miss my upcoming videos. If you are a returning subscriber, I appreciate you. So, intragroup trading. Intragroup trading. Intragroup trading. In the group point of view, the word says says to the parties outside the group. When you use the word says, it means the goods are sold to non-group members. Where goods are sold between the member of the group is assumed to be transferred. So the right word is transfer. So that means if you use the word transfer in group, it means the goods are sold between the members of the group. Where group are sold between the members of the group, such goods is assumed to be transferred. I said transfer means the sales between the members of the group. Where goods are transferred between the members of the group at the cost, no further adjustment is required. If it costs the seller 100,000 and the seller transfer it at the same price, we don't need any adjustment. But in some cases, the seller may transfer the goods at a profit. Then, where goods are transferred at a profit, then you will need an adjustment for the unrealized profit. Where goods are transferred, where goods are sold at a profit between the members of the group, you will need the adjustment for unrealized profit. The word realize in account means to sell. Unrealized profit is the amount of profit attributable to the unsold goods. The profit attributable to the unsold goods is known as the unrealized profit. I want you to know that if you want to calculate the unrealized profit, it is the portion of the goods transferred which have not been sold to the third party that the unrealized profit should be calculated upon. Where H sells to S. H sold goods worth $100,000 to S. And S have sold 60,000. S have sold 60,000 of the goods bought from H to the third party. That means the S will still be left with 40,000 in inventory. S will still be left with 40,000 in inventory. So if you want to calculate the unrealized profit, that unrealized profit should be calculated on this 40,000, on the portion that have not been sold by the buyer to the third party. On the portion that have not been sold by the buyer to the third party. Here, you will need the knowledge of markup and margin. So, markup is the profit calculated on cost. The profit calculated on the cost price, that is markup. So, the profit expressed as a fraction or percentage of the cost price, that is markup. While profit calculated or expressed as a fraction or percentage of the selling price, that is margin. Markup is on cost. Markup, that is cost. Margin, that is on selling price, on sales. Take note of that. So, now, I want you to know that cost price Irrespective of the situation, cost price is always 100%. So where markup is added, marked up. Let's assume the marked up is 20%. If you add the 20% to 100%, then you'll be having 120%. This 120% is the transfer price. Where the value you are given is at the transfer price, the one in inventory. That means to calculate the profit, you know this markup is the profit. The markup there is the profit. So to calculate the unrealized profit, remember I've told you that the unrealized profit will be calculated on the unsold inventory. So to calculate the unrealized profit, you have 20 over where the amount you are left with in inventory is at the transfer price. Then you have over 120 times the transfer price of the unsold stock, transfer price of the unsold stock. But where the amount you are given is at the cost to the seller. So the unrealized profit now, unrealized profit will be equal to 20 over the cost price times cost price of the unsold stocks. So, because it is the cost price of the unsold stocks you are given. Take note of that. Here, before you can have 20 over 120, it means the equivalent amount of the unsold stocks must be at the transfer price. The equivalent amount of the unsold inventory must be at the transferred price. Take note of that. So that is the calculation of unrealized profit. But if the percentage you are given is margin, I've told you that your margin is on sales. And if you are given profit margin now, unrealized profit, if you are given margin, that means you are using 20 over 100 because it's already margin. You don't need to make the denominator times transfer price of the unsold inventory or stocks. That is where profit margin is given. Please take note of this. So that is the calculation of the unrealized profit. Now, recognition of the unrealized profit now. Recognition of unrealized profit. How are the unrealized profits recognized? In the consolidated statement of financial position. Now, the first question you ask yourself is who the seller is. Where parent is the seller. Where parent is the seller. That means it is the parent that have earned that profit. Where parent is the seller, it is the parent that have earned the profit. It is the parent that have recognized that profit in its financial statement. Therefore, deduct the unrealized profit from the retained earnings of the parent. So if I say retained earnings of the parent, I'm referring to consolidated retained earnings. Remember, everything in accounting is double entry. If one entry is to deduct it from the retained earnings of the parent, then also deduct the unrealized profit from the consolidated inventory. That is where parent is the seller. So the accounting entries now, debit retained earnings of the parent, or consolidated retained earnings, or you can put retained earnings of the parent. Then credit consolidated inventories. So if parent is the seller, the calculation of the provision for unrealized profit will not appear in the summary of subsidiary net assets, because the summary of the net asset is the subsidiary net asset. We don't use to prepare the summaries of parent net asset. You don't need that. The summary of net asset you need is that of the subsidiary. So if parent is the seller, the unrealized profit will not appear in the summary of the subsidiary net asset. But where subsidiary is the seller, that means your unrealized profit will appear in the summary of subsidiary net asset. Where subsidiary is the seller. Where subsidiary is the seller, then unrealized profit should appear in the summary of subsidiary net assets. This is because if subsidiary is the seller, remember the profit of the subsidiary will still be shared between the parent and the non-controlling interest. So that means if you are putting the unrealized profit in the summary of the subsidiary net asset, or in the post-acquisition profit of the subsidiary in the summary of net assets, that means you are indirectly sharing that unrealized profit between the parent company and the non-controlling interest. So don't be confused, because you might see some other treatments whereby they apply, let's say parents acquire 80%, they calculate 80% of unrealized profit. They deduct it in the parent company's retained earnings. Then when they get to non-controlling interest, they calculate 20% again. They deduct it in the calculation of non-controlling interest. Don't be confused. I have compressed those adjustments. Just follow what I teach you. Don't say, I'm going through this example, the treatment there is different from what you explained. They are not different, just that they took it in another way. I've tried to simplify the group account as much as possible, and I've discovered that this approach I'm using will avoid some mistakes you might have committed in other methods. So that is why I came to this method. You will arrive at the same result at the end. Don't worry, just go on with what I'm teaching you. So where subsidiary is the seller, that means the unrealized profit will be deducted from the subsidiary's retained earnings and from the consolidated inventory. So deduct the unrealized profit. Deduct the unrealized profit from the retained earnings of the subsidiary. That is where the subsidiary is the seller. Since subsidiary is the seller, deduct the unrealized profit from the retained earnings of the subsidiaries and from the consolidated inventories. So that is the adjustment. Remember, the retained earnings of the subsidiary, you will have gotten that in the summary of subsidiary net asset. So that may adjust for your unrealized profit in the summary of the subsidiary's net asset. That is the treatment of intergroup trading. By the time I take work example, you'll be able to understand that better. The number 2 item I'm going to explain is the impairment of goodwill. Impairment. Number 2, impairment of goodwill. Remember, in accordance with IAS 36, we said impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. The amount at which the carrying amount of an asset exceed its recoverable value. That is impairment loss. Impairment is always a loss. There is nothing like impairment profit. There is nothing like that. It's always a loss. Impairment is always a loss. That is why it is usually deducted in profit or loss. Usually deducted from the retained earnings. The treatment of impairment loss depends on the group policy. It is the group policy that determines the treatment of impairment loss. Now remember, we have two policies as to the valuation of the non-controlling interest, where the group policy on the valuation of non-controlling interest, where the group policy on the valuation of non-controlling interest is proportionate share of the subsidiaries' net assets. So I want to explain the treatment of impairment loss, where the group policy on the valuation of non-controlling interest is proportionate share of the subsidiaries' net assets. Remember, this method can also be called partial goodwill method or old method. It is partial goodwill method because it recognizes goodwill to the parent only. So it means the goodwill calculated under this policy, it is the goodwill attributable to the parent companies only. So where such goodwill is impaired, the whole of the impairment loss must be borne by the parent company. Parent is going to bear everything. Since the goodwill calculated under this method is goodwill to the parent only. So the treatment of impairment loss here, you deduct the impairment loss from the retained earnings of the parent company and from the calculated goodwill. So the double entry is debit parent retained earnings and credit consolidated goodwill. That is the treatment of impairment loss where policy is proportionate. I've told you that proportionate method is also called partial goodwill method. I've told you being a partial goodwill method, it recognizes goodwill attributable to the parent company only. So if goodwill attributable to the parent is impaired, parent company is going to bear the whole of the impairment loss. So that is why we are going to debit the parent company's retained earnings and credit consolidated goodwill. We are not going to use the impairment loss. In such instance, you are not going to use it in the summary of subsidiary net assets. You don't need to use it in the summary of subsidiary net assets, since the whole of the impairment loss belongs to the parent company. Number two, where group policy, where group policy is fair value. Another word for fair value is full goodwill method. Full goodwill method or new method. The proportionate is old method. Old method only recognizes one type of goodwill, while the new method, the fair value, recognizes two types of goodwill. The goodwill to parent and goodwill to non-controlling interest. This method recognizes two types of goodwill. Number one is the goodwill attributable to the parent company and goodwill attributable to non-controlling interest. That is why this method is also called full goodwill method. So if goodwill calculated under this method is impaired, the impairment loss should be shared between the parent company and the non-controlling interest based on the parent stake in the group. You apply the parent company percentage on the impairment loss. You deduct that parent share from the retained earnings of the parent, and the subsidiary share, the remaining, the NCI share, you deduct it from the calculation of NCI. But I've told you to avoid such ambiguity. Deduct the whole impairment loss from the subsidiary retained earnings in order to get the adjusted post-acquisition profit of the subsidiary. Remember, the adjusted post-acquisition profit of the subsidiary will still be shared between the parent and NCI based on the percentage of holding. In that case, you are sharing the impairment loss between parent and NCI indirectly. So, where group policy is fair value, you are going to deduct the impairment loss in the summary of net assets. Impairment loss should be used in what? In the summary of subsidiary net assets. That is where policy is what? Fair value. Deduct it from the summary of the subsidiary net asset. Then also deduct it from the calculated goodwill. That is the double entry. Debit retained earnings of subsidiary and credit consolidated goodwill. Credit consolidated goodwill. So just make use of this adjustment. So don't bother to share it. Sharing it, sometimes you might forget, and if you are not very good, so you might make some mistakes. So just deduct it in the summary of net assets from the subsidiary retained earnings. Then you know that the second leg will be on the goodwill. That is the treatment of impairment loss. The third item I'm going to examine is intragroup current accounts. Intragroup current accounts. That is number 3. Intragroup current accounts. Intergroup current accounts. Current account is an account maintained by the individual company within the group to reflect the amount payable or receivables from each other. Account maintained by the individual company within the group to reflect the amount payable or receivables from each other. That is current accounts. I want to know that intergroup current account is usually an asset, to this selling company, selling or lending company. Intergroup current account is usually an asset to the selling company or lending company. Why it is a liability? Liability to the buying company or borrowers, company that is borrowing. So that same thing, you will see them as an asset. In most cases, current assets. Then that thing that is also a current asset will also appear as a current liability in another entity. So you might have them like that. I want to know that intragroup current accounts should be eliminated. We always eliminate the intragroup current accounts, whether it agrees or not. But in some cases, the intergroup current account may not be given separately in the individual company's financial statement. So where it is not given separately, then you are going to deduct it from intragroup group current accounts from the consolidated receivables and consolidated payables. So, where it is not given separately, if it is given separately or if it is given as a separate line item, just deduct it from consolidated receivables and at the same time deduct it from consolidated. If it is given as a separate line item, just eliminate it. But if it is not given as a separate line item, deduct it from consolidated receivables, at the same time deduct it from consolidated payables. Where the intragroup current account is given as a separate line item in the individual companies within the group financial statement, that you should eliminate the intergroup current accounts, whether it agrees or not. But where it is not given as a separate line item, and if you have it in the footnote, intragroup current accounts should be deducted from the consolidated receivables. At the same time, it should be deducted from the consolidated payables. Take note of that. But in some cases, the intergroup current accounts may not agree. The amount included in the payable may not agree with the amount included in the payables. The reason for the difference may be as a result of items in transit. Items in transit. This item in transit might be inventory or goods in transit. Goods in transit. Meaning that one person might have sent some goods or returned some goods to the other. So where one person sent goods to the other, and the person who sent it have recorded it that, okay, this thing is, I have returned it or I have sent it back to this so person. And the person to whom it is sent have not received it. So the goods is still in transit, still on the way. So in that case, the current account will not agree. So that means the reason for the difference might be as a result of goods in transit. And where somebody has sent some money to the other, so the reason might be as a result of cash or check in transit. So I've told you that the reason for the difference in intergroup current account is as a result of items in transit. I've told you that the items in transit might be goods in transit or cash in transit. I've also told you earlier that whether the current accounts agree or not, that the intragroup current accounts should be eliminated. I've told you whether the current accounts agrees or not, that intragroup current accounts should be eliminated. Where the reason for the difference in current accounts is as a result of item in transit. If the item in transit is goods in transit, you are going to add the goods in transit to the consolidated inventory, while current accounts should be eliminated. Where the item or the reason for the difference in current account is as a result of cash or check in transit. The cash or check in transit should be deducted from the consolidated cash or cash equivalent, while current account should be eliminated. So, where the reason for the difference in current account is as a result of, let's say, goods in transit. So you are going to add goods in transit to consolidated inventory, while current account should be eliminated. Eliminated. 2. Where it is as a result of cash or check in transit. Then you add cash or check in transit to the consolidated cash or cash equivalent, while current account should be eliminated. I've told you that your current account should be eliminated whether the current account agrees or not. So it is the amount included in the receivable that should be deducted from the consolidated receivables, and the amount included in the payables that should be deducted in the consolidated payables, where the current account fails to agree. The current account should be eliminated. Example, Hertz bought 90% of the equity share capital of safety 2 years ago on 1st of January 20x2, when the retained earnings of safety stood at $5,000. Statement of financial position at the year end of 31st December 2023 as follows. We have Hertz safety amounting $1,000. We have non-current assets. Property, plant, and equipment, Hertz 100, safety 30. Investment in nets at cost, Hertz 34. Total non-current assets 134 and 30 for Hertz and safety respectively. We have current assets, which include inventory, Hertz 90, safety 20. Then we have receivables, Hertz 110, safety 25. Bank, Hertz 10, safety 5. Total of current assets, Hertz 210, safety 50. Total assets, Hertz 344, safety 80. Equity, share capital, Hertz 15, safety 5. Retained earnings, Hertz 159, safety 31. Then equity total 174 for Hertz and safety 36. Non-current liabilities, Hertz 120, safety 28. Current liabilities, Hertz 50, safety 16. Total equity and liability, Hertz 34, safety 80. Safety transferred goods to Hertz at a transfer price of $18,000 at a markup of 50%. 2/3 remains in inventory at the year end. The current account in Hertz and safety stood at $22,000 on that day. Goodwill has suffered an impairment of $10,000. The Hertz Group uses the fair value method to value the non-controlling interest. The fair value of the non-controlling interest at acquisition was $4,000. Prepare the consolidated statement of financial position at 31st December 2023. Now, let's have the solution. I've told you the first thing is the group structure. We have the group structure. Group structure. You were told that Hertz bought 90% of the equity share capital of safety 2 years ago. Hertz bought 90% of the equity share capital of safety 2 years ago. That is the group structure. This is a simple group structure. After the group structure, if this is working one, the next thing is the summary of the subsidiary net assets. Summary. And the subsidiary is safety. Summary of safety net assets. Summary of safety net assets. I've told you we are going to have a column for post acquisition retained earnings. You have a column for date of acquisition. DOA stands for date of acquisition. Then you also have a column for date of consolidation, which is DOC. I've told you that the DOC is just a memorandum column. So the major column you need is DOA and post-acquisition. Just that all the amount will be here, so which will not be transferred between this and this. Now, the first thing I said, you should lift your equity. Please go and watch my first video on group accounts for better understanding. Try to watch the part 1, my first video. I have them in an organized playlist. So always search for ICAN playlist on each of the course you need for performance management, for mathematics, for quantitative analysis, for operation research, for SFM or financial management, for performance management, for public sector accounting and finance, for taxation. I still have some top courses in mind which I have not examined. I have on MI financial accounting. So I have in all of these courses. Please search for playlist. So in a playlist, you might be having like 50 or more videos. So search for playlist for each of the course. If it's performance management, just search for ICAN performance management playlist, financial reporting. So you will see the playlist. Now, you have share capital. You know, this is for head. The head is the parent. You don't need the parent. This is for safety. What you need is for safety. We have share capital safety 5, retained earnings safety 31. So we have share capital, safety 5, retained earnings. For safety, we have 31. I've told you don't need that of the parent because what our focus is the summary of safety net assets, summary of subsidiaries net assets. So now your share capital, your DOA will always be the same as your DOC. So you put 5 here. 5 minus 5, need. Then your retained earnings, back to your question, where you have information about acquisition. So you were told head bought 90% of the equity share capital of safety 2 years ago on January 20 X1. This is the date of acquisition. When the retained earnings of safety stood at 5,000 naira. This is the retained earnings of subsidiary at the date of acquisition. So retained earnings is 5,000 naira. So 1,000. So the retained earnings is 5,000. Subtract 5,000 from 31. 31 minus 5. That will give us 26,000. Please take note of this. Now back to the note, the additional information. You were told safety transferred goods to head at a transfer price of 18,000. This is the transfer price, the selling price. The transfer price means selling price. At a markup of 50%. I've told you that cost price is always 100%. So listen, this is cost price. Cost price is always 100%. And you are given marked up, which is profit. Marked up means profit. And you are given marked up of 50%. That means the transfer price now, transfer price will be 100 plus 50, which is 150%. This is the transfer price. Transfer price, which is cost price plus profit, equal to selling price. Another word for transfer price is the selling price. Now, the transfer price is 18,000, and you want to determine the markup, the profit. So the unrealized profit. I've told you that unrealized profit, provision for unrealized profit, provision for unrealized profit. That is PURP, provision for unrealized profit. Take note of that. Now the profit now is 50, and what you are given is the transfer price. If it is the cost price you are given, then you have profit over cost, and cost is 100. But since it is transfer price you are given, it will be profit over transfer price. So which is 50 over 150. I've told you if it is the cost price of to the seller you are given, it will be 50 over 100 since cost price is 100. If it is transfer price, the profit will be 50 over transfer price, which is 150, times the transfer price of the item is $18,000. $18,000. Remember, I've told you that unrealized profit is always calculated on the unsold items of inventory. Is it the whole of this 18,000 that have not been sold by the buyer to the third party? No. Back to the question. You were told 2/3 remain in the inventory at the year end. The one that remain unsold is 2/3. So you have times 2/3. That means the unrealized profit now, you have 50 divided by 150 times 18,000 times 2 divided by 3. That gives us 4,000. The unrealized profit, provision for unrealized profit equals to $4,000. That is the unrealized profit. Unrealized, I've told you, is calculated on the unsold items of inventory. You have to ascertain the portion of the inventory that have not been sold by the buyer to the third party. Therefore, provision for unrealized profit equals to 50 over 150 times 18,000 times 2/3 that remains in inventory, and we got 4. I've told you that this unrealized profit should be deducted from the retained earnings of the seller. You have to be sure whom the seller is. The seller is safety. Remember, the summary of net asset we have here is the summary of safety net asset. If parent is the seller, you will not need to use it here. It will not appear in the summary of subsidiary net asset if parent is the seller. You will only use it in the summary of the net asset if subsidiary is the seller. I've told you to avoid the ambiguous connected with sharing this unrealized profit between the parent and the non-controlling interest. Better still that you can use it in the summary of net asset. Because if I say calculate 90%, since the parent stake is 90%, you calculate 90% of 4,000, that gives us 3,600. You deduct 3,600 from the retained earnings of the parent, then the remaining 10% of 4,000, which is 400. You deduct the 400 from the non-controlling interest, that will be times sapient. So just deduct the unrealized profit from the retained earnings of the subsidiary, that is in the summary of net assets, where subsidiary is the seller. But if parent is the seller, you will not need to deduct it in the summary of net assets. Just deduct it from the consolidated retained earnings. Please bear this in mind. Then we are deducting it from the retained earnings of the subsidiary because subsidiary is the seller. That means the safety. Safety is the subsidiary. Safety is the seller. That is why we are deducting the unrealized profit from the retained earnings of safety. Please take note of that. Back to the question. We've calculated the unrealized profit. I've told you that this one, the current account in health and safety stood at 22,000 on that date. I've told you that intergroup current accounts should be eliminated. Now, you check the statement of financial position under assets. Now, let's check the statement of financial position under assets. We do not have current accounts there. There is no current accounts under assets. We don't have current accounts under assets. Then under liability, we don't have current accounts. So that means your current accounts will have been merged with your receivables, and at the same time, it will have been combined with the payables. Your payables is part of your current liabilities. Therefore, your current accounts now, you are going to deduct it from the receivables and the payables. Intergroup current accounts should be eliminated. I've told you, you eliminate intergroup current accounts if it is given in the statement of financial position under current assets and current liability. If it is not given, deduct it from receivables and from payables. And if it is not, if receivables is not given, that means it will have formed part of your current asset. If receivable is not given, you may be given current asset total. You are going to deduct the intergroup current account from the total of the current assets. At the same time, you deduct it from the current liabilities. Take note of that. That is for the treatment of intergroup current accounts. So, intergroup current account should be eliminated. I've told you that where the intergroup current account disagrees with the amount that is included in under assets is different from the amount included as liabilities, that the difference might be as a result of an item in transit. Where the item in transit is an inventory in transit, then you are going to eliminate it from consolidated inventory. And if the item in transit, if the item in transit is inventory in transit, you add the inventory in transit to consolidated inventory. Add it, please. Take note. Add the inventory in transit to consolidated inventory. If the difference as a result of cash in transit, you add the cash in transit to consolidated cash or cash equivalent. I will still take a question in my next video that will involve where the current account will not balance, where the current account are not the same. That is, where the reason for the difference may be as a result of either inventory in transit or cash in transit. Please take note of that. Now, goodwill has suffered an impairment of 10,000 naira. I've told you that the treatment of, if you have watched my earlier video, my first video, I've told you that the treatment of impairment loss depends on the parent company's policy as to the valuation of the non-controlling interest. And if the policy is fair value, that you should deduct the impairment loss from the summary of subsidiary net assets. That is deducted from the retained earnings of the subsidiary, if the policy is fair value. But where the policy is proportionate, that you should deduct the impairment loss from the retained earnings of the parent company and from the consolidated goodwill calculated in the usual way. Now, in this case, the policy, you were told, the heads group uses the fair value method to value the non-controlling interest. The policy is fair value. So the policy is fair value. You are going to deduct the impairment loss from the subsidiary net assets because the policy is fair value. I've told you that where the policy is proportionate, deduct the impairment loss from the parent company's retained earnings. The other entry will be in goodwill. So, but the reason why I'm deducting it from the subsidiary net asset is that the goodwill valued or calculated under the fair value method comprises the goodwill to parent and the non-controlling interest. That means the impairment loss should be shared between the parent company and non-controlling interest. If you apply 90% of 10,000, it will give you 9,000. That means 9,000 should be deducted from the retained earnings of the parent. Then 10% of 10,000 will give us 1,000. That means 1,000 should be deducted from the non-controlling interest. But in order to avoid that ambiguity connected with that treatment, I said, just forget about sharing it. Forget about sharing the impairment loss where the policy is fair value. Just deduct the impairment loss from the summary of net assets of the subsidiary. That is where the policy is what? Fair value. Fair value. Fair value. Please take note of that. Please take note where policy is fair value. I'm repeating this statement so that you will not misunderstand the concept, because it is only where the policy is fair value. I've told you that another word for fair value is full goodwill method or the new method. That this fair value method recognizes two types of goodwill: the goodwill to the parent and goodwill to the non-controlling interest. Then proportionate only recognizes goodwill to the parent. So the impairment loss under proportionate need not to be shared between the parent and the non-controlling interest. But the fair value under fair value needs to be shared between the parent company and the non-controlling interest, because the goodwill calculated under the fair value comprises the goodwill to the parent company and the goodwill to the non-controlling interest. Please take note of that. So please take note. So since the policy is fair value now, the whole of the impairment loss, we are going to use it in the summary of subsidiary net asset. Now, back to the financial statement. We have a summary of the subsidiary net asset. We have impairment loss. of 10 million. So you are subtracting that impairment loss from the subsidiaries retained earnings. Now back to the question. You were told the fair value of the non-controlling interest at acquisition was 4,000. This is necessary for the calculation of the goodwill and the non-controlling interest. So this is the summary of subsidiary net asset. Now let's cast it. So what is the total? So this is 10. 5 plus 31, that is 36. 36 minus 4 and 10 minus 14. We have 22. 22. This is 26. 26 minus 14. Then we have 12. 12. So this is the summary of subsidiaries net asset. Then the next working 3, is the calculation of goodwill on acquisition of goodwill on acquisition of safety, acquisition of subsidiary. I've told you that to calculate goodwill, you start with your purchase consideration or consideration transferred. Purchase consideration. How much was the price paid by the parent company for the acquisition of the subsidiary? Please, before you go into the statement of financial position to look for the purchase consideration, always check your note where you have information about acquisition. Please take note of that. Because the consideration given in the note may not always be the same with the one given in the statement of financial position. Where the consideration given in the note, where it doesn't agree with the one given in the statement of financial position, it is the one given in the note that should be used in calculating goodwill. But in this case, there is no purchase consideration given where you have information about acquisition. So we are going to use investment in safety as our purchase consideration, the one given under non-current asset. So where the amount given in the statement of financial position is greater than the one given in the other in the note, the difference will represent simple investment or other investment, which will appear as a separate line item, in the consolidated statement of financial position. So in this case now, we are using this 34,000 as a purchase consideration. So you have 34,000. Then you add the fair value of non-controlling interest at acquisition. How much is the fair value? Go back to the note. The head group uses the fair value method to value the non-controlling interest. The fair value of the non-controlling interest at acquisition was 4,000. That is the fair value of our non-controlling interest. So you add the 4,000. 4 plus 34, you have 38. Then you now deduct the fair value of net assets at the date of acquisition. You will always get this from the summary of subsidiary net asset, the column, the total, whatever you have in the total of DOA. So DOA, date of acquisition, which is 10,000. So the fair value of net asset is 10,000. So you have 10,000. If you subtract 10,000 from 38,000, then you'll be having 28,000. This 28,000 is goodwill. That is our goodwill. But remember, the goodwill has been impaired by 10,000. So you are going to deduct the impairment loss of 10,000 from your goodwill. So you have impairment loss. Impairment loss. Impairment loss of 10,000. If you subtract 10,000 from 28,000, then you'll be left with 18,000. That is our consolidated goodwill. Consolidated goodwill, 18,000. Now, for our purpose, let's just start preparing the consolidated statement of financial position. Then we'll be doing other workings alongside with it. Head group, parent company's name. Consolidated statement of financial position as at December 31st, 20x3. So you are starting with the non-current assets. Non-current assets. Remember, I've told you that consolidated statement of financial position will be prepared by adding line by line the individual item in the parent company financial statement with that of the subsidiary company after deducting the intra-group balances. Now, the non-current assets include property, plant, and equipment. So we have property, plant, and equipment. Property, plant, and equipment. For health, we have 100. For safety, we have 30. We don't have any information about transfer of PPE or the fair value. We don't have anything, fair value of property. So we don't have additional information on property, plant, and equipment. So just add it. So you have 130. I will still release a video where there will be transfer of property, plant, and equipment. There will be fair value adjustments and others. So we have, that is, the investments have been used in calculating our goodwill. So the next thing will be goodwill. Goodwill. So from our earlier working, we have goodwill working 3. Goodwill that amounted to 18,000. Goodwill working 3. Then we have 18,000. If you add 18,000 to 130,000, then you have 148,000. After that, the next item is current assets. Current assets. So we have current assets. Current assets. Then our current assets include, as part of our current assets, we have inventory. Inventories. So we have 90,000 for parent. 90, the K stands for 1,000. Plus 20,000 for subsidiary. Remember, we have an unrealized profit from sale of inventory calculated earlier. So we've calculated an unrealized profit, provision for unrealized profits, and we got 4,000. So that unrealized profit should be subtracted, should be eliminated from our inventory. So 4,000. So 90,000 plus 20,000 minus 4,000. So our current assets is totaled, our inventory is totaled 106. After inventory, we have receivables. Receivables. For parents, we have 110. 110,000. Subsidiary receivable, we have 25,000. Then remember, we have intergroup receivables. Back to the note. We have the current account in health and safety stood at 22,000 on that day. I've told you that we have intergroup current account. This is an intergroup current account. I've told you earlier that the intergroup current account should be eliminated. Since current account was not given as a separate line item in the statement of financial position of the parent company and subsidiary, that you should eliminate it from receivables and payables. So in that case, you have minus 22,000. So minus 22,000. So 110,000 plus 25,000 minus 22,000. So we have 113,000. 113,000. That is receivables. After receivables, we have bank. So bank, for parents, we have 10 and subsidiary 5. So we have 10,000 plus 5,000. That gives us 15,000. So we are done with our current assets. So the current asset is totaled. Now 113,000 plus 106,000 plus 15,000. So our current asset is totaled 234. 234. Then add the current assets to the non-current asset of 148. So 148 plus 234, then you have 382. 382. That 382 is our total assets. Total assets. 382. Now, after total assets, remember the next section of the statement of financial position is equity and liabilities. Now, let's have equity and liabilities. Equity and liabilities. Under the equity, we have share capital, which is 15,000 and 5,000. I've told you that we don't use to add the share capital of parent and subsidiary. The only instance where the share capital will vary is if there are further acquisition, further issue of shares after acquisition, and that is not usually examinable. They don't usually test that for examination purpose. And another instance is if there are shares consideration or share exchange. And in this question, we don't have anything as such. So it is the parent company share capital alone that should be used, because the subsidiary share capital and even the retained earnings has formed part of the intergroup items, part of those things that were acquired, the net assets acquired. So we are not going to consider the net asset was acquired. We are not going to consider the net asset of the subsidiary here. So we have share capital. Share capital. That is parent only. Parent only. The share capital of the parent. And that is given to be 15,000. 15,000. After the share capital, the next item is retained earnings. Retained earnings. Retained earnings. Retained earnings, let's have that as working for. We've not done that. We've not done that previously. So we want to have the retained earnings working for now. Working number 4. Working for, which is retained earnings. Working number 4, retained earnings. I've told you that you should always start with parent retained earnings as per statement of financial position. And the name of the parent is head. So you have head retained earnings as per statement of financial position. Go back to the statement of financial position. So we have retained earnings. Retained earnings, that of head is 159. This is for safety. We need that of head, 159. So you put 159. Then you now have head, that is the parent. Head share of post acquisition retained earnings of the subsidiary, and subsidiary is safety. Remember what head acquired in or from safety is 90% of their stake. So you have 90% of how much is the adjusted post-acquisition retained earnings of safety under the post-acquisition retained earnings column. In the summary of safety net asset, you have 12 there. So you have 90% of 12,000. This is 12,000. 90% of 12,000. 90% of 12,000. That gives us 10,800. 10.8. So if you add the 10.8 to 159, Then you have 169.8. 169.8. 169.8. So our retained earnings is 169.8. 169.8. Now, if you add 169.8 to the share capital of 15 plus 15, then we have 184.8. 184.8. After this, you have the non-controlling interest. Non-controlling interest. Let's have this as working number 5. Working number 5 for non-controlling interest. Working number 5 for non-controlling interest. So we have working 5. Non-controlling interest. Non-controlling interest. So you start with the non-controlling interest. Fair value of non-controlling interest at acquisition. The fair value of safety non-controlling interest at acquisition was given to be $4,000. You were told the head group uses the fair value method to value the non-controlling interest. The fair value of the non-controlling interest at acquisition was 4,000. So you have 4,000. 4,000. Then after that, you have NCI, share of adjusted post-acquisition retained earnings of safety. Remember, the percentage attributable to NCI is 10%. Since out of 100%, 90% were acquired by the parent. So 10% of go back to the summary of net assets. You have post-acquisition retained earnings to be 12. So you have 10% of 12,000. That gives us 1.2. If you add 1.2 to 4, then you have 5.2. 5.2. That is our non-controlling interest. So you transfer it to the consolidated statement of financial position. 5.2. If you add 5.2 to 184.8, 5.2, so you have 190. That is the total of the equity. That is the total equity. Now, after equity, you have non-current liabilities. Non-current liabilities. Non-current liabilities. Non-current liabilities, that of health, we have 120. Safety, 28. So you have 120,000 plus 28,000. So if you add it up, you have 148,000. Then after non-current liabilities, you have current liabilities. Current liabilities. Current liabilities include, you have current liabilities, health, 50,000. Safety, 16,000. Remember, you have intergroup current account. I've told you that since current account was not given separately was not given as a separate line item in the statement of financial position of the individual entity, that is parent and subsidiary, that you are going to deduct it from receivables, which have been done under current assets. Then you are equally going to deduct it from payables. Remember, payables is part of current liabilities, so we are going to deduct the 22,000 from current liabilities. So since payable was not given separately, so we have minus 22,000. So we have 50,000 plus 16,000, that is 66,000 minus 22,000. So you have 44,000. So our current liability is total 44,000. So you now add your equity and liabilities. What is the total of equity and liabilities. Now, this is the consolidated statement of financial position. So, we have equity. This is our equity and liabilities. This is our equity. Our equity is totaled 190. So, we have 190 plus non-current liabilities of 148 plus current liabilities of 44. So you have 382. 382. This is the total equity and liabilities. Total equity and liabilities is 382, which agrees with our total assets of 382. So that means our account balance. This is the end of the solution to the question. Please share the videos with others. Share the video with others. Also, like the video. Thanks for watching ICAN.